Hello, everyone, and welcome to the webinar. I'm Nick Zulovich with Cherokee Media Group, and pleased to welcome you to our session titled Risks Solved, Lending Evolved, the Predictive Forecasting Revolution, with Joe Breeden, who is the CEO and Chief Scientist at Deep Future Analytics. Before we get into today's session, just a couple of quick items to mention. We are recording today's session, so keep watch of your inbox for a message containing a link to it so you can review the presentation and share it with your teammates. And if you have any questions for our expert, please use the Q&A tab here on Zoom, and we'll get to those questions after the presentation. So that's more than enough for me. Let's get right to Joe Breeden and our feature webinar titled Risk Solved, Lending Evolved, the Predictive Forecasting Revolution. Joe, the webinar floor is all yours.
Thank you. And thank you everyone for joining today. Just briefly about me. I'm Joe Breeden, CEO, Chief Scientist of Deep Future Analytics, as was mentioned. I'm also President of Model Risk Managers International Association. I've been in this industry doing predictive analytics about 25 years, founded Deep Future Analytics around 2013, and I'm happy to say that in 2019, Allied Solutions became a co-owner and partner of Deep Future Analytics. Today, I'm happy that I get the opportunity to talk to you about what has been going on in auto lending in our industry. What we see as some of the emerging challenges that we need to deal with, and finally, what we're going to do about those things. From an analytics perspective, how can we help? So it is challenging today for auto lenders. If you look at what has happened in 2021 and 22, this has been a volatile period. I want to walk you through industry loan volumes, credit spreads, credit quality, vehicle values. These are some of the things that we have to deal with. Now, it's interesting to talk about auto loan originations. What I have on this graph are an overall industry index, just normalized to make these comparable. The blue line is showing total auto loans, and the orange line is showing credit union auto lending. And what's fascinating about these two is historically they've tracked very closely. But if you look at what happened in 2022 and even began in 2021, there was quite a divergence where credit unions booked a lot of loans at a time when banks and others cut back actually on some of their lending. So why is that, and what does that mean for us? It has some interesting dynamics, to say the least. The first, and I realize this graph gets a little complicated, so I'm going to take it slow here, but the gray line you see is again that credit union auto lending index. The blue line is the average interest rate on a 60-month auto loan, and the orange line is the yield on a 5-year government bond as a reference. And so if you can see the spread between the blue and the orange, when the Fed started raising rates quickly, lenders could not just match them day by day. The rate increase was too rapid. Consumers would have panicked appropriately. So lenders had to gradually step into that change. So it means that the 5-year bond yield went up much faster than what auto loan rates went up, and the spreads got very compressed. So this 2021-22 period where credit unions were doing so much volume was also a very low yield period for those loans. That spread is compressed. It has since recovered, but of course volume is down now. So you could say that borrowers took advantage of this. But it's also interesting to ask which borrowers did that. So one of my key points today is to talk to you about adverse selection. Adverse selection, simply put, is that you don't get the loan quality you expect. We usually talk about FICO, LTV, differences between direct and indirect, those sorts of things. But even if you account for all of that, there can be shifts in credit quality that are not explainable from those things. The classic reason is competitive pressures. The lender across the street cuts rates and you don't, and you're left with not the best borrowers, whoever they rejected already. But there's also a macroeconomic adverse selection. And this is more when the conditions change who wants a loan. There can be underwriting issues. And also, right now, we're dealing with score inflation. Score inflation means that we know everyone's received checks in the mail during the pandemic, and that gave them an ability to pay their bills, which was not ongoing and not reflecting their true willingness in the future to pay those bills. So it has a distorting effect. So if we look at these things, quick estimate on bureau inflation. I didn't come up with these numbers. I can give you the references, but for prime borrowers, post-pandemic, what we're seeing is the performance looks like the scores have been inflated by 35 points, meaning that, to put it differently, when you lend to somebody with a certain score, their performance is as if their true score were 35 points lower. So this is the effect of all that government assistance during the pandemic, helping people pay off their bills, even though that may not be reflective of their true financial situation. The effect is even stronger among subprime, where it can be as much as 50 points. So this means at the lower end of the scale, the borrowers are not as good as what we would think they are. Of course, that's going to lead to some poor performance in the portfolios. But there's also an issue at the upper end of the scale that doesn't usually happen. Now, we have seen this before. I did a research project with a senior scientist at the Philadelphia Federal Reserve. In 2006, 7, and 8, our models started to predict that credit quality was deteriorating rapidly. And the reason for that deterioration was not clear at the time, to be honest. But we also saw falling demand and a number of other suggestive things. So when we did this research project, we were looking at what causes macroeconomic adverse selection, and can we predict this in the future? Now, the short answer is that when interest rates rise rapidly, as they have, or when the cost of what you want to buy is going up fast, such as a home or a car, you have to look at the personality of the borrower. Now, bureau data doesn't tell you personality, but we know personality matters. And what we see is in these periods of rapid change, you can think of a certain group as value shoppers. They buy when they're given a discount. They buy when the price is right. In the last 2 years, the price has been wrong. Price is going up fast and interest rates going up fast. So the value shoppers are going to step back and say, I'm going to wait and see how this plays out. I'm not in a hurry. The impulse buyers, and that sounds derogatory, but folks who need it, can't wait, even if they should, that's who's left in the market. And so this effect of losing the value shoppers and being left with those who are less financially self-aware, this is actually strongest among the prime and super prime borrowers. And so what we've seen is across the board deterioration in the last couple of years. The gray line on this graph is our measure of residual risk in auto loans. And back around 2015, 2016, there was a little bit of a period of higher risk, and then things got better. This happened in a lot of products. 2019 was a particularly good period of residual quality. But 21 and 22, this value shopper effect, where they left the market and left you with the riskier borrowers in ways you can't see from bureau data, it means that this is a high risk pool, and they were booked in high volume, and they were booked at very low yields to the lenders. So that's tough. Unfortunately, that is not a good situation. And we know among our clients that a lot of them are now dealing with delinquency rising and losses rising, specifically on these vintages. It's not about the economy necessarily, because we're not having a recession yet, right? But we do see delinquency rising. And this is not just in auto. This is also happening in some other products. So this is a wider effect. It's something we need to be aware of and something we need to track going forward, because you can see on this graph, it may go up sometimes, but it'll come down again at other times. And so as this comes down, it creates opportunities in the future. We'll get to that again. I will say we've been tracking this with data back to 2003, and what happened in 2021 and 22, this is the worst residual risk we've seen in that period. Even though 2006 and 2007 were poor quality loans in auto as well as mortgage and other products, not as bad as this. And it's just because of how rapidly interest rates went up. We also have to look at vehicle values. So these borrowers were buying expensive vehicles, to be honest. So that feeds into this notion of adverse selection. Why did they want to buy when vehicles were so expensive? That is now trending a bit lower. The blue line here is courtesy of Mannheim, their used vehicle value index. So as that trends lower, before too long, it may meet up with the inflation line, because we've had a period of high inflation. So at that point, we will consider it normalized. It does not have to come back to where it started from. But this creates a challenge, of course, going forward. If we expect higher delinquency and loss from these pools, and the value of the vehicle they bought is declining, that means net losses could be higher on these as well. So that's what we have to deal with. That's what's on the books. But where are we today and what's going to come next? So I want to look at some economic indicators, consumer spending, delinquency, student loan repayment, even things like student loans we have to think about because they may have cars. So first, what about rising delinquency? These graphs are a little busy, but it's trying to give you a industry-wide perspective on this. And we have seen in the last couple of years rising delinquency. And I should say the last year. This rising delinquency is not easily explained from a recession. We don't have one. But we do have interesting things going on. So I mentioned poor loan pools we're dealing with. But one possible explanation for this gets back to the pandemic savings. And there have been a number of studies coming out related to this. The Fed publishes some data. Groups like Goldman Sachs and JP Morgan put out their estimates. What we have seen is that the pandemic savings, either keeping those checks the government sent you, or simply spending less during the pandemic, not traveling and such, created quite a pool of savings that we haven't seen in a while. But consumer spending has been quite aggressive. Americans don't sit on their cash very well. And so that money has been burnt off. You can see the peak on here was late 2021 through 22 and 23. That has been coming down. And depending on the income tier, that is essentially gone now. It has all been spent among the lower 80%. The top 20% still has some savings. But even though the money has been spent, there's a question about how is spending still so strong? And this is where people are spending into their credit cards and personal loans and those sorts of things. My theory here is that we created a habit over the last 2 years of aggressive spending. And so it's kind of a spending hangover. It may take a while for consumers to learn what they can really afford to spend and pull back to living within their means. So we're getting a little bit of spending momentum here that is probably leading to some additional delinquency. Another thing to deal with is student loan payments. And of course, we had the pandemic forbearance. This graph is total consumer debt coverage ratio. So it's the consumer debt relative to income. And what you see here at the end is an estimate that was made indicating that the amount of debt service required by consumers could be 30 to 40 basis point increase on the scale. That will put it back to levels not seen since around 2010. So on this scale, it looks small because back in 2003 and 2005, there was quite a bit of debt there. But in a low interest rate environment, that debt service coverage ratio was a lot lower. So this is actually a rather dramatic increase. Now, the SAVE program is meant to help consumers. Those who may be delinquent already will automatically qualify for additional assistance or forbearance. So there's going to be a lot of attempts to help those who have student loans. But also, the federal government is not going to report student loan delinquency to the bureaus for the next year. So anyone who goes delinquent on a student loan over the next year, you won't know. And that means if they want a new car loan, or if they're already on your books and you're looking at their payments, you won't know that they're already delinquent somewhere else. That creates a challenge. Now, you may want to think about this when it comes to loan origination. If the government doesn't want to report this, you probably are not, they wouldn't want you to ask, try to find out if they're delinquent. But it does mean that that pool of student loan holders may be higher risk. So there's some important things to consider there. We are in the final stages of a project with TransUnion and Boston Consulting Group, estimating the net portfolio impact of student loan repayments on portfolios like auto loan portfolios. And hopefully within the next few weeks, you'll see that released. So check back on that. So where do we go from here? What about 2024? Could there be a recession? What about interest rates? What about loan quality? So what I've had to say so far, 21 and 22, not great years for booking loans. And it's worth pointing out that I have webinars I recorded back at the beginning of 2021 saying, these are the conditions that create adverse selection. So not a total mystery that this happened, but adverse selection is not widely known. Don't feel badly if you haven't heard about it. Obviously, I was one of the ones doing the initial research on this. And so lenders are still learning about what causes these conditions. And hopefully next time around, it'll be more widely understood. But just because it has been bad doesn't mean it will be bad. We want to look at what comes next. So first of all, what about rates? With our clients, we generate economic scenarios. We look at, of course, what the Fed is doing, what GDP could do. We gather hundreds of different inputs to try to predict where the economy might go, just to provide economic scenarios. My personal feeling is that the most likely outcome next year is a mild recession. It is sliding out a bit. And, you know, we thought there might have been the beginnings of a mild recession this year, but it hasn't happened. Depending on what happens in the economy, interest rates will change. The worse of a recession that we have, the more interest rates will come down, the faster they will come down. Historically, the Fed always drops rates when there's a recession. So we have some expectation that they might come down next year. So what do we do about that? First of all, stress testing. Now, what's interesting about a falling interest rate environment is that it doesn't necessarily impact your delinquencies, but it will impact your prepayments. And again, you think about that 2021 and 2022 pool of borrowers, the risky ones are probably stuck with you, but the ones who have options may choose to refinance at lower rates. So yields could fall further if rates come down next year. On the other hand, you as a lender can also offer those who have loans elsewhere to get a better rate with you. And so there is, this is where stress testing comes in, looking at the yield risks in your portfolio, not loss risk, but yield risks and opportunities. As those rates fall, what do your yields look like, and can you book good quality loans at those rates? We will need to target collections to high risk, high value pools. So if there is that mild recession, that means that we need to look at which vintage groups those delinquent accounts are coming from, because early delinquency in a 2019-2020 borrower is not the same as early delinquency in a 2021 or 22 borrower. These are different personality groups. 2020 was a great time to buy. 2022 was not. So that tells you something about the mentality of the borrower. It may make it harder to prevent default among the 21 and 22 pools. So collections doesn't usually think about vintages, but the personality of the borrower is kind of a hidden variable. It's something we don't get from the bureau, but it is a strong indicator. And the best indicator of that personality type is when they got the loan. That's pretty much the only indicator we have. So look at vintage when you're considering how risky that pool is. And of course, you have to look at the value. Those high-priced auto loans, as they risk default in a falling vehicle value market, of course, are your greatest risk. So you're going to have to pay attention there as well. Planning for retention, as we mentioned, the risk of prepayment is going to rise as we get into a falling interest rate environment. So we need to look at that. It means that for your better borrowers, if they are at risk of refinancing with somebody else, you may want to jump in and do this first. On the other hand, if they're in a risky pool, you may decide to let them go. So loan retention is not a one size fits all. It is judging that risk relative to the borrower. And, yield risk comes both with prepayment and charge-off considerations. Of course, we also have to look at loss reserves. Now, everyone has just had to adopt CECL. And I don't know anyone who likes CECL. It's not about that. But CECL has its flaws. I will tell you that with lines of credit, I would design CECL differently had it been up to me. But if you want to understand the lifetime loss for a pool of loans, if you implement CECL well, it is the correct answer for an auto loan. Term loans is where you can do CECL right. Now, weighted average remaining maturity and some of these simplistic methods, and NCUA offers simplistic methods. There are a lot of things like that, but if you do your loss reserve right, it can be integrated with your stress testing and your yield forecasting. So that's when I say doing it correctly means doing it well enough that can be part of your decision making. So setting your loss reserves for possibility of recession risk, falling interest rate environment, rising student loan repayment, all of these things are part of your loss reserves and part of your portfolio management. They all come together. And then lastly, it comes down to preparing your 2024 strategy. Meet the market strategy misses a lot of opportunities. And what we have always seen historically is that lenders are overpriced relative to the risk coming out of a recession. Now, it's nice when you can get good yields, but it means there's an opportunity there. The best time to grow volume for any loan type is just past the peak of a recession. Because as you go through a recession, if you're doing underwriting, you can do employment and income verification. You can check and see if they can afford the loan. And if they have their job and income holds up in a recession, well, they've already passed the hardest test. And then as you look forward, the markets are usually overpriced then because rates haven't come down, but the risk is coming down. And so creating yield models to show how much flexibility you have in an improving economy, in a falling cost of funds environment, and lastly, potentially in an improving credit risk environment. So I mentioned adverse selection earlier, and it has been bad in the last 2 years. But in the next 2 years, as rates come down, those value shoppers that are sitting on the sideline, this is when they will be most aggressive about returning. So the best quality loans are usually the ones booked just as we get past the peak of a recession, because they see an opportunity to get a lower interest rate. The cost of vehicles may be lower. Everything aligns for them. So that is your best borrower. And you can get it at relatively higher yields. And if you want to grow volume and you drop that price just a little bit, you can get quite a bit of volume at still good yields. So there is a possibility later 2024 and certainly 2025 could be real market growth opportunities, both for refinancing the loans that are good somewhere else, but also for originating those best borrowers. You want to track credit quality more than FICO. So this is what I was referring to in that adverse selection discussion. So all of this comes to predicting yields. And I am often surprised at how unsophisticated most yield forecasting is, because honestly, most of the folks I work with, well, not the ones we work with, but most of the folks I meet start with a yield forecasting model, which is basically last year's loss rate and last year's prepayment rate, but at today's interest rate, at today's spread. That's not going to help you manage through the cycle. When you're going into a recession or coming out of a recession and everything is dynamic, last year's loss rate and last year's prepayment rate are not the right answers. So you need to look at that yield forecasting model and do it better. Short answer. And to be honest, to be blunt, that's what we try to help with. So I appreciate your time. I've gone through things quickly here, Nick. Kept it kind of tight, but I'm happy to elaborate on any of these points.
Absolutely. Excellent job, Joe. So much great information that you have shared. And if you have questions for our expert, Joe Breeden, the CEO and Chief Scientist at Deep Future Analytics, just use the Q&A tab here on Zoom, and we'll get to those questions as time allows. And Joe, so again, so much great information that you shared. A couple of questions that came to mind as you were going through it. No doubt you've seen and heard the phrasing in regard to interest rates, that the higher for longer scenario might be in play. Looking at perhaps the 2023 vintage that's being compiled as we speak, if rates continue to be higher for longer, as some have pontificated, how might the 2023 vintage be in comparison to that 2021 and 22 vintages that you pointed out in your presentation? How would you perhaps categorize that 2023 paper if in fact the higher for longer scenario comes to be?
Well, from a credit quality perspective, I'm not feeling aggressive this year yet, because it's consumers respond to change in rates, change in price. We get used to a certain level, and this is where I question whether the Fed pays attention to change as much as level. Obviously, they did things very fast, and it caused a lot of pain. But from a consumer perspective, the analysis we've done is that they look back over a period of about a couple of years. So I would say from the consumer's perspective, rates are flattening. And if we just kept these rates next year, flat means that those who are still good borrowers, but they can't wait forever to replace that old car, some of them will start to come back. If rates were to come down, we'll get more and it'll be better demand. But the credit quality is moderating. It is slowly improving right now. We'll probably continue to slowly improve. So that's not bad. Higher longer means less prepayment. So our yields could hold up on these pools. Higher for longer is not necessarily bad for the lenders. And the folks I've seen, yields were compressed in 2022 as they tried to catch up. They have caught up to current yields. And so those spreads are not bad at these levels. So I think 2023, certainly second half, can be okay. Even if we stay roughly these levels with small improvement next year, that's not so bad. There will be more opportunity. So over time, demand will grow, and higher demand is better quality. That's always the lesson we learn. When demand falls, and you have to look at total industry demand, you don't want to be the one with high demand just because everybody else cut back and you're the one left. That's not good demand. But if total industry demand rises, that's a good thing. So to that point, the Senior Loan Officer Opinion Survey, SLOOS, SLOOS, you can look that up. Every quarter, they survey loan officers asking if they see higher or lower demand across all product types. That survey, I've talked to people who respond to that survey and they say, gee, I never know what to put down on that. I just kind of guess. And yet there's a wisdom of the masses, right? That if you correlate that survey to credit quality over the last 3 decades, which we have done, it's amazingly good. So I highly recommend tracking that SLOOS demand survey to get an idea of borrower demand, and that demand correlates to loan quality. So perhaps not what you expect, but that's a good thing to track with.
Very good. Again, our expert for today's webinar, Risk Solved, Lending Evolved, the Predictive Forecasting Revolution, is Joe Breeden, the Chief Executive Officer and Chief Scientist at Deep Future Analytics. And if you have a question for Joe, just use the Q&A tab here on Zoom and we'll get to it. And Joe, kind of a connected question. You referenced toward the end of your presentation the potential for refinancing that credit unions or captives or banks or whomever perhaps could offer. Just perhaps some back of the napkin math, so to speak. How much should providers watch as far as any rate cuts that might be happening by Fed policymakers? Should they begin looking at this avenue if rates drop 50 basis points or 25 basis points? What does the math kind of say that when refinancing should be engaged based on any type of rate drop that might be happening? What does the math say there?
Well, it depends to a certain extent on the borrower tier, because for example, the lower income borrowers, are not so sensitive to rate itself. What they're sensitive to is payment. And so for them, refinance means being able to offer them a lower payment, monthly payment. And so, we know, roughly speaking, actually you can know from the Bureau, but we know, roughly speaking, over time, which vintages had which APRs. We know what people are sitting on. And so we know where the opportunities are and the age of the loan, the vehicle for new cars. So you can make some educated guesses there about where you might want to help. If the economy is going into a recession and there's increased loss risk, you may not want to extend to longer term, but you can keep a shorter term, but at a lower payment. As we come out of that recession, I don't think it would be a long one. So maybe later next year, we'll be talking about, if things are looking better, you can offer a longer term. So both lower rate and longer term to lower those payments. And that could be quite appealing to those borrowers. For the upper tier, it's pretty straightforward. What's their rate today? What could their rate be? How much can you cut that? How much can you reduce their interest payments? And you'll get takers. We know that there was significant volume at low rates back in 2019 and 2020. You're not going to get to refinance those. So it's going to be cherry picking out of the 21 and 22 pools. We know they're risky pools, but they're not all risky. So looking at those who've held up over those 2 years will give you an idea of who should be refinanced, who has proven themselves, and get them into a better deal.
Closing moments here with Joe Breeden, the CEO and Chief Scientist at Deep Future Analytics, with our webinar, Risk Solved, Lending Evolved, the Predictive Forecasting Revolution. And Joe, just to round us out, perhaps it's the multi-billion-dollar, perhaps trillion-dollar question, just reiterating the data points or strategy that you care to share. Just how do you see auto finance companies using the data to find those applicants who are the best to offer credit toward, to build the most robust portfolio that they can? Just any parts of the data trends or analytics you care to reiterate to help providers build the best portfolio they can?
Yeah, I think one of the surprises that come out of the analytics that we've been doing over the last couple of decades, really, one of the things we've had to learn is that FICO doesn't tell you price or yield. And it only gives you part of the perspective on a borrower. This personality type that I'm talking about, whether they're a value shopper or an impulse buyer, you won't learn that from your bureau. It's not reflected in what their current FICO score is. It's something more than that. And I'll give you an example. That one of the first times I saw this was not related to the economy. It was that I was doing analysis for an auto finance company portfolio based in Minnesota. And we had several years of data, and we looked at this residual credit risk by month. And it was kind of odd that we saw that credit quality was really good every December, and credit quality was really bad every June. And for the same FICO score, this was not about shifting FICO score, LTV. We normalized for everything that they had in their data, all the usual stuff. But there's this residual risk, and it was dramatic, factor of 2 kind of residual risk. And so you just have to sit back and think about it. Well, who's buying a car in December in Minnesota, right? You're going to stand out on a frozen car lot and argue over price because you know that they're going to have a tax hit at the end of the month and you'll get your best deal. They got to move some vehicles, right? Versus June, it's pretty nice in Minnesota in June, and the cars are shiny and the balloons are flying and the sun is out, and you've just gotten through a miserable winter, come on, they're all miserable, right? This is not the same guy. Okay. The December borrower and the June borrower are different people. And relative to long economic cycles, you're saying the same thing. They're not the same people. And when demand falls, we lose those financially savvy people first. And so this is a subtle point that I'm bringing up a lot, because of all the things we looked at, this is the least appreciated and one of the most important unmeasured effects. And we can't measure it. I get asked all the time, so who are these people? How do I measure this? I don't want to book those loans. I want to know at the point of origination who the impulse buyers are, and I will change their price. I'll do something. It's like, yeah, that's a great idea. I've only seen one study where someone successfully measured who was an impulse buyer or a value shopper. A Chinese group embedded a tracker in web browsers for Chinese consumers and looked to see if people were going to price comparison sites before buying or going straight to the branded site to buy what they wanted. And the price comparison shoppers they called value shoppers, and the other ones they called impulse buyers. And this was dramatically useful in measuring credit quality, and pretty much 100% illegal here. We are not going to do that. We're not even going to think about doing that. Maybe somebody has some alternate data that would give you a personality index. I don't know. I haven't seen it. But the truth is, all we can do is say, in certain conditions, we have to worry that our pool of borrowers may shift, because really we're just lending to a pool of all personality types. And so it's a challenge. And it means that when we think about our portfolios, we have to think about the credit quality we can see, the credit quality we can't see, but we have to assume can change. That's this personality. And the economic environment they're going to mature in. So we don't usually think about all these three pieces, and it's very difficult to do without analytics, to see these things, to measure them, and to combine these pieces to get a real portfolio forecast, yield forecast, cash flow forecast. This is where you need the predictive analytics that we talk about. And so this is why we focus on that with Allied Solutions. So yeah, that's the transition from intuition can be great, but there are limits. And this is where you make the transition from intuition to analytics.
Absolutely. And a last final transition, Joe, if you could show your last screen of your presentation, if finance companies want some assistance with those challenges that you referenced, how can they get connected with you and your team at Deep Future Analytics?
Absolutely. If you have a friend at Allied, give them a call. We work through the Allied representatives. Happy to do that. But if you're not working with Allied, if you just need a point of contact, certainly contact me, Breeden at deepfutureanalytics.com.
Very good. That's Joe Breeden, CEO and Chief Scientist at Deep Future Analytics. Joe, thank you so much for the great information and insights here on our webinar today. Thank you again.
Thank you, everyone. Take care.
And on behalf of all of us at Cherokee Media Group, we thank you so much for joining us, and we look forward to having you again next time.